Good afternoon and welcome to Williams Island TV. It's not often that we get a chance to interview and meet with some of our residents on the island that have such a amazing background, educationally, involvement in the community, but more importantly on today's interview, involvement in the country as it stands today. Extremely knowledgeable. His whole life has been dedicated to legal, but economic legal. So I'd like to tell you a little about, and this is a very difficult interview, by the way, because it's very hard to interview somebody or question somebody when he is so far more knowledgeable than I am about these subjects, but we're going to give it a shot anyhow. Larry Thompson, who lives in the Williams Island, lives in the 6000 building, was vice chairman of the Depository Trust and Clearing Corporation, known as DTCC. He served as the chief legal officer / general counsel of the firm since 2005. He has more than 30 years of experience as a senior executive in corporate law, risk management, and regulatory affairs. In his role as DTCC vice chairman, Mr. Thompson served as senior advisor to DTCC and was responsible for all legal and regulatory activities of the company and its subsidiaries. He regularly interfaced with government and regulatory agencies on issues impacting the company. Mr. Thompson was chairman of the board of DTCC, derivative Serve LLC, and former chairman of the DTCC Operating Committee. He was a member of the DTCC Management Committee, which is comprised of the company's executive leadership. In addition, Mr. Thompson was a member of DTCC Management Risk Committee, where he helped oversee and assess a broad range of issues related to market capital and operational risk facing the corporation. Mr. Thompson previously served as chair of a DTC board subcommittee charged with reviewing the potential risk impacts of high-frequency trading algorithms trading as a result of the Knight Capital Market event in 2012. Mr. Thompson is a former co-chair of the Internal Risk Management Committee and former chairman of the Depository Trust. I could go on and on and on, but as you can see from this, and this is a brief summary of a very long and successful career. The reason I wanted to have Larry with us today is the economy is on everybody's mind. And obviously it's affecting everybody in some manner, whether it's through the stock market, whether it's jobs, whether it's the economic impact, whether it's the fear of when does this lead into a recession, if it does at all. So rather than me speak a lot, I'd like to introduce you to Larry if you haven't seen him. He's the fine gentleman that you can see at our bar in the lounge. Usually around 2, 3, 4 o'clock, he has a hat on, a sport jacket, he's drinking his glass of wine, relaxing, and then I'll come over to him and drive him crazy and say, we need you on television. So, thank you for being with us.
Thank you for having me.
No, it's my pleasure. It's our pleasure.
Well, thanks again, Bob, for having me. I appreciate it.
Well, I have to start out by asking you, and you know, everybody's trying to figure out what is going on in the world today of economics. So I'm going to ask you in a very broad way, what is going on today in the economy of the world?
That's a big question.
And
it's a very broad one, and there are lots of things that are happening through the economy on a worldwide basis. I mean, first of all, we got a war going on in the Ukraine, which is affecting Europe, especially their gas and oil markets. But here in the U.S., we got a housing crisis that's just been deepened quite a bit. We have a lot of buyer's remorse in the marketplace when it comes to housing now. And you probably have seen mortgage rates have been going not quite through the roof, but pretty close to it lately.
Compared to what they've been, yeah.
Compared to where they were, 2 years ago, 18 months ago, rates are really extremely high. Part of that is because of the rate increases that the Fed has been very aggressive at trying to bring the inflationary pressures under control in the economy. And I think they will be successful in doing that. Unfortunately, that success may mean a recession for the broader U.S. economy. And if the U.S. catches a cold, which it probably will do, then the rest of the world will probably catch pneumonia.
So I guess the question is, and how do we get into this to begin with? I mean, we go through COVID. obviously people aren't spending, they're not going out, they're not using their dollars. So if anything, you would think instead of inflation, it would cause deflation. And yet, it caused this inflationary reaction. The Fed started raising these rates pretty quickly because they had to do something. But at what point is that fine line where the increases of these rates could possibly drag us into a modest recession, a slight recession, or whatever? How do they measure the balance of the two?
Well, I mean, I'm not a Fed economist. I'm not an economist by training. But, you know, my understanding of what the Fed is facing is the pandemic actually did lead to a lot of inflation. And the inflation was this. The inflationary pressure that you saw was a reaction to the fact that the pandemic hit everybody and a lot of people were out of work. So what they did was try to juice up the economy by giving everybody a lot of funds. And the Fed was very successful at that. And as you may recall, they put trillions of dollars into the economy. Well, those trillions of dollars call inflationary pressure. As you may recall, one of the things that happened was the cost of used cars went through the roof.
Yes.
And that was a measure of inflationary rise in the economy. The fact that all of those used cars were being bought at inflationary prices. So you had that happen at the same time that you had the deposits going in from the pressures that the Fed had put on raising the funds. You had a lot of deposits that went up at the banks. So the banks felt that they didn't have to pay interest rates at the levels that they were paying previously because they had plenty of liquidity in the form of deposits. And that caused a couple of things to happen. First of all, a lot of our seniors lost interest income that they thought they were going to receive through the investments that they were making. That didn't occur because, quite frankly, the banks didn't have to pay high interest in order to attract deposits into their account. And that meant that housing prices began to fall. Housing prices fell. Mortgage rates also fell at the same time. All of those, I think, in the end were, inflationary pressures into this marketplace that have caused a lot of things to happen. The other thing that happened, I believe, is the Fed really did not read very carefully what the inflationary pressures were. For the longest time, you said they reacted quickly. I actually would disagree with that slightly. I think they reacted, but I think they were a little slow to react at first. They kept.
And let me qualify. Yeah, what I meant was, I think they should have started 18 months to 2 years ago. I'm saying in this past year, though, there was a tremendous amount of increases. That's what I was referring to.
Yeah, I would agree with you that they should have started probably 18 months ago before they started the rise that they did. They're now trying to play a game of catch-up. And so for the first time in history, you saw 4 straight 75 basis point increases by the Fed. That's unprecedented. Even during Volcker's time, that never happened. You had a 1% increase, then you had a series of 50% basis increases, but you never had 75 basis point increases the whole time. I think the next time around, we'll probably only have a 25 basis increase. That'll be this coming February. And then again, when they meet in March, I think there will be another 25 basis point increase. After that point in time, I think the Fed is probably going to take somewhat of a wait and see attitude, maybe for 2 to 3 months, to see if that increases the number of job holdings that should go down, and try to get it to a soft landing as opposed to a hard recessionary landing. I think they'll wait until probably June or July before you see any more increases.
After the next two.
But if you don't see any major decrease in inflationary pressures, I do think you will see another 3 to 4 25 basis point increases the latter part of this year, taking us to almost a 6% increase overall from when the basis for most of these actions was really about a 25% increase at the beginning of the cycle.
So you made a statement which is interesting. You talk about soft landing, and you hear the term soft landing, hard landing. Will it happen? Won't it happen? we've seen the market, in spite of what's going on, it seems to, in the last couple of months, or the last month, sort of become a little bit more comfortable with the economic surroundings, and it has had some upward swing. But what I'm curious about is, when you talk about inflation, what actual items are they? Because the housing market has slowed down, mortgage rates have gone up, people are putting money into treasuries more than they've ever done because you're getting 4.5%, 5% interest in treasuries today. Gas has come down. What is it, other than maybe food, that is causing the reaction to be, well, inflation is still going at the wrong pace?
Well, remember, prices were high at the beginning of this cycle.
Yes.
So if you look at the cost of eggs right now, a dozen eggs costs you almost $9 here in Florida.
Yes.
In some states, they'll cost you as much as $12. That's really high for low-income families to be able to do for a staple such as eggs. Milk, meat have all gone up in prices. But you also saw an increase, I think, in some of the other staples that people use as well. You mentioned that housing costs have come down. Well, that's true of those who own a house. For those who have to rent, rents have actually been going up
Yes, rents have.
significantly. So yes, it's okay for those who rent out a house that rents are going up, but if you are a renter, you're spending probably 30, maybe 40% of your disposable income on housing now. That's a significant increase that you got to deal with. And I think you see more and more of those. So you mentioned gas and other staples that you have, food. The food prices have been high since the pandemic. And they were high in the pandemic because people were out of jobs.
You couldn't get the products.
And you couldn't get the products, and a lot of things were in short demand. And when those that you could get, it took you a long time to get them because the supply chain was so backed up. You know, not just here in the U.S., but obviously overseas as well. So the supply chain was backed up tremendously, and that has increased, you know, the cost and the economic power of people have dissipated tremendously. So I think that, you know, when you start with an inflationary period that was as high as 10% in some of the food staples that we're talking about, with eggs and some of the other staples being even higher than that, 25% increases, you know, the Fed has got a long way to go before they can get those prices to really begin to stabilize at a lower level. And if you're looking at a 2% inflationary pressure, which is what their aim is, that's what they aim for, I don't think they're going to quite frankly be able to see that.
Yeah, well, I mean, I believe 2% is a little aggressive. I think 3.5 is probably more realistic.
But it may be that 3.5 is something that they'll have to learn how to live with.
Exactly.
I think at the moment, though, this Fed, led by Jerome Powell and Lyle Brainerd, you know, is really pushing for the 2%.
Yes, they are.
And I think that's what they're aiming for. And I think, quite frankly, they got a good chance of trying to get it, especially if we have a recession.
Well, I came back, I was up in New York a couple of weeks ago, and I went to a, call it an economic roundtable. I enjoy hearing what the supposed experts, and I use that quote.
I'm not an expert.
Nor am I, trust me. But you hear the conflicting stories. And one of the issues that came up, which was very interesting, was brought about by one of the chairmen of Oppenheim. And I remember he said, the topic he said was, is raising the interest rates the right tool to bring down inflation? Will raising those interest rates cause some of these consumer staples, some of these other issues to come down, or are they making it worse? Because it's not affecting, the guy that's going to buy eggs is not affected by interest rates. Now, maybe the manufacturing company that has the chicken farm may be affected if he borrows. But then what does he do? Does he slow down the chicken egg? You know, so the question is, why is raising interest rates such a major tool for the Feds to use to bring down inflation?
Well, remember, the Fed only has a certain number of tools in its toolbox. And the major tool that it has is interest rate increases. That's the major tool that they have. They don't really have any of the other tools. I mean, in fact, what they really need to do is they need to work with Congress to try to come up with some other tools that the Congress can come up with to try to lower inflation by increasing output on the demand side, which is what you're talking about.
Yes.
And what it sounds like the Oppenheimer chairman
Yeah.
was speaking to, is that you really need to increase output and manufacturing if you're going to really have an effect on eventually the inflationary pressures
Yes,
that we're talking
and
about.
his theory was, if you still have a supply and demand where there's little supply, no matter what you put the interest rates at, there's still no supply. So there's nothing to bring the prices down. You just explained exactly. If you had more product, if your shelves were full of product, then the prices would come down because, it's a demand issue.
Well, and to some extent, the Fed has been trying to deal with that by, jawboning Congress and saying to them, look, you need to do your part as well. Unfortunately, we got pretty much a dysfunctional Congress at the moment.
Yes.
We have one party in control of the House, we got another party in control of the Senate and the administration, and the two of them don't talk to one another, and you have extremists on both sides. So you don't have the kind of, situation where you really need bipartisan legislation in order to get to the manufacturing and to help out with the kind of supply and demand issue that you're talking about, Bob.
And the sad part is, as you brought up, right now it is a dysfunctional government, and I'm not talking political on either side. It's dysfunctional. I don't think at the most critical time this government is facing, they have a government that's going to work together in a bipartisan manner to do some of the things you talk about. So unfortunately at this time, it is the feds only that can make any change, if at all.
Well, and you see it. One of the key things that we're talking about is the U.S. deficit right now. And as you know, that's being held hostage, at least by one of the parties, to try to get cuts in Social Security and Medicare, which the other party is not going to agree to. And what it could do is obviously affect the U.S. economy, because if the U.S. defaults on any of its debt, quite frankly, that's a situation I would not want to see. It would be worse than the recession that we saw after Lehman Brothers in 2008.
And I was going to ask you about that because in the middle of all of this, the debt limit has been reached. You have a dysfunctional government that has no ability right now to come up with a bipartisan solution, which is the only way they're going to come up with it. They're holding hostage this debt limit because of cuts they want to make. And the effect is, it could be catastrophic.
It could be
They say
catastrophic.
it's only going to make it till June or July before their accounting principles run out.
Yeah, I think two things are helpful in regards to the debt limit. First of all, you got even the Senate minority led by McConnell, Mitch McConnell, who've said that the U.S. will never default on any of its debts, which I think is very helpful. And also, it's against the 14th Amendment, which also says that the U.S. will never default on any of its debts. So you got a constitutional issue here. And my own judgment is both sides will hold out until things get really, really tough. That probably won't happen until April or May,
I would say.
before you really see any serious movement. But in the end, I think both sides will have to compromise, just like we did in 2012. Remember, this is a situation that occurred during the Obama administration in 2012. And what it did is it actually cost the U.S. a lower grade when it came to U.S. investments. We actually got downgraded by all of the rating agencies at that particular time. I think it could cause another lowering of our debt rating, which would be catastrophic for the U.S. government because it means you'll have to pay even higher interest rates on your debt than you pay right now.
It was very interesting because at this seminar they talked about this issue. And they said it's a very sad commentary, but how many of the people in Congress today really understand the debt limit terminology? How many understand the impact or the ramifications? It's interesting. Yes, there are some that obviously do, but a lot of these newcomer or these extremists have no clue what they're talking about.
No, well,
And that's frightening.
First of all, there are very few people in Congress who understand economics.
Exactly.
And very few of them really had real jobs that they actually had to work at before they became politicians. Most politicians, unfortunately, are lifetime politicians. and all they do is they run for office. And if you're in the House, by the time you get finished getting reelected, it's time to get
Start
ready
campaigning again, yeah.
for the next election.
Right.
So, basically, in my judgment, you really don't have the right people running the U.S. government. And remember, the debt limit is a fiction. It's something that we created. It's not something that was born by the U.S. Constitution. Because if you follow the U.S. Constitution, it says the U.S. will never default on its debt. That was put in purposely by the founders of this country because they understood the fundamentals of economics. You cannot have a country default on its debt and still be a sovereign country that will offer its debt to the rest of the world, and people will accept that. And the U.S. right now is a preeminent country that has never defaulted on its debt. So you don't want the dollar not to become, the money of choice that everybody uses. It's a good thing for the U.S. that it is.
We talked about you, DTCC, and your past, and it's remarkable. It's just such a amazing past. But explain, because I'm sure most people don't have a clue what DTCC is and what the role of that is in terms of the economy, the management, the risk management, as you say.
Yeah, well, DTCC, the company, the Depository Trust and Clearing Corporation, itself is a holding company. But the three operating companies that are underneath it, DTC, National Securities Clearing Corporation, NSCC, and the Fixed Income Clearing Corporation, FICC, they clear the bulk of the trades that occur here in the U.S. So all of the trades that you see in the New York Stock Exchange, on NASDAQ, and over-the-counter, we clear all of those trades. So 95% of most shares in the U.S. are held in street name.
Correct.
That street name is CD & Co. That's DTCC.
Okay.
That's one. The clearing corporations clear all of those trades. And the clearing corporation that clears most of the ones that are really important, such as all of you mentioned treasuries earlier, but also the fixed income market, such as housing, muni bonds, things of that sort, those are also cleared by the Depository Trust and Clearing Corporation. So to give you some idea of the scope and the size of what it does, last year alone, DTCC cleared this dollar amount. It was 2.75 quadrillion in money market securities.
My God.
It's a big number.
Yes.
And a quadrillion, just to give you what that number is,
Yeah.
is a 1 with 19 zeros behind it. They did twice that number, more than twice that number in 1 year. So it is indeed the largest company that nobody knows about and what it does.
I was going to say. So the question is then, obviously years ago, people held the certificate themselves. They bought 100 shares of IBM, they got a certificate.
Yeah.
Now today everything's in a street name. No one gets certificates anymore.
No.
So obviously this company, this clearinghouse, has had to grow over these years.
Yeah, and it was set up, by the way. I mean, I always viewed DTCC as the original fintech company because it was set up during a time of crisis when everybody used to own their securities.
Right.
Mom and pop owned their securities, put them underneath their mattresses, kept them that way. If you wanted to trade them, you'd have to take those securities off from underneath your mattress.
Back, yeah.
You'd have to sign them on the back. You'd have to take them to your broker-dealer. The broker-dealer would then, go out and sell them. And there was about 15 million shares a year that were being traded. That was it.
Yeah.
The old New York Stock Exchange, along with NASDAQ and the American Stock Exchange, only did about 15 million shares a day. A year, actually. Now, if you look at the numbers that we're talking about, the New York Stock Exchange and NASDAQ, I think, do something like maybe 2 billion shares a day that they trade back and forth. So the numbers are massive. Now,
Well, it's interesting because I have a friend who used to have a couple of seats on the exchange.
oh, okay.
And back then, and this was back, I'm going to guess, it was in the 70s and 80s, and there were 18 booths, and each booth had 80 companies. that the specialist worked out of.
Oh, yeah.
And he had to know which booth to run around to buy the shares, and then he'd go to another booth and this. But at that point, there was only 18 booths with 80 shares, so it's maybe at 1,000, 1,500 companies. Could you imagine if it didn't go computer, how that exchange could have ever worked with the volume we do today?
It would not have worked.
You couldn't have, yeah.
I mean, the specialist system worked fine for what it did. There are no longer any specialists left. All of the specialist firms are gone.
No
Spear
question.
Leeds and Kellogg was bought by Goldman Sachs. All of the other specialist firms went the way of the, you know, the car, basically, the horse and buggy.
So the question then is, it's interesting because obviously if you and I want to buy 1,000 shares of something, we're back on the line of what's really going on. These major companies, these algorithms, these computers are trading hundreds of millions of shares of stock or hundreds of thousands of shares. Do you think that the algorithms and all this computerized trading, obviously it has to have some kind of computerization to handle a volume, but at the same token, you see such fluctuations in the market that you never saw to that extent before. Is it also a detriment?
Well, it can be. It can be for the individual investor who wants to be in the marketplace. The market is, I think, too sophisticated, too complex for an individual investor to really do. And if you look at the large trading firms now, the Citadels, the Virtues, even Warren Buffett, they have large machines behind them. They use artificial intelligence. They use algorithms to trade these stocks. The average person doesn't have the ability to do that.
No.
And therefore, if they're not using some sophisticated system or investing in an advisor, then they won't be able to really play the market very effectively.
But do you think the fundamentals of a company still have that much to do with pricing? I mean, the old expression, throw the baby out with the bathwater. Today we see if a tech stock company, Microsoft, has a bad day, so does the whole tech division. And it's almost like there's no longer the fundamentals that are controlling pricing as much as the emotions or the reaction.
Well, you're talking about momentum trading.
Yeah.
And, look, I'm not a trader. That's not what I did. And I'm not an advisor, so I don't advise people to be in the market or out of the
Aren't
market.
you lucky?
What I try to do myself is try to hire the best talent that you can. Make certain that you got an advisor who knows what he's doing, that the advisor has all of the kind of resources behind him that they should have, a sophisticated organization, the kind of banking system that makes sense, and that you can take advantage of all of those things, and you can try to save your money in a conspicuous way and make money. But, look, the fact of the matter is an individual who wants to try to trade with the big guys is going to lose every time.
Well, somebody once told me that's true. By the time we hear about it, it's old news.
Yeah, well,
It's
you
not
see,
new anymore, by the way.
when you see the market move the way the market's been moving
Right.
at various times, you know that there's been some market-making event that's happened, but
Exactly.
you don't know what it is.
No, and chances are we never will know.
Well, you may know. I mean, I dealt with the night issue when I was at DTC, and effectively what happened there was, you had a technical error. It was basically somebody did something with a trading algorithm that they shouldn't have done. A mistake was made, and a lot of shares got traded that shouldn't have been traded. It could have led to the firm going into bankruptcy. As it turned out, that we were able to save that firm from going into bankruptcy. I feel really good about that.
But wasn't there an incident where the market dropped 1,000 points because somebody hit the wrong number or something on a
Well,
computer?
you get fat finger mistakes happening all the time.
Yeah.
These, what they call them a fat finger, right?
Uh-huh.
You meant to hit X, but you hit X and Y. I don't know if those things will ever stop happening. I mean, you could have that happen with a code, because everything is now written in code, various codes. And so the artificial intelligence is going to be only as good as whoever's coding that artificial intelligence. If you don't code it good, then you're going to get a lot of junk out of it.
Well, I think one of the smartest guys is Bloomberg because he puts together this amazing platform, but never gives advice, just gives information.
That's why he's a smart guy and why I don't give advice, and I'm not a broker-dealer. So please don't listen to me. All you hear here is Larry Thompson's thoughts on various matters.
And you know something, they probably are as good. I mean, okay, you say that. I have to ask you, they talk about, okay, you have after-hour trading. You have the specialists who predict whatever's going to happen. You have the volatility that goes into the option trades, whatever. But who are these people? They say they. Who are the they of the world that has so much influence on the price of a stock based on earnings, based on news, based on their predictions? I mean, you go on and you look at the specialists, what they analyze, stocks is trading today at 10, it's going to go to 50. Who are these people that are making some of these moves that have such an effect on the market?
Well, I mean, a lot of them are pundits that you see on TV.
Yep.
So, I remember the day when the stock market, at least when I was growing up, if you heard about the stock market, you heard about it for like 5 minutes on the evening news. Now you got all day reporting about
Right.
finances.
Correct.
And you got pundits that you got to fill the time with. And so it's really the pundits that are really
Yeah.
pushing all of this out.
So-
and do they have the right kind of mechanism? I mean, the specialist system on the New York Stock Exchange it basically disappeared. You really don't.
Totally.
You don't really have that anymore.
No.
The specialists used to be able to control, what the prices were for various things. But the specialist role was twofold. They had to buy and they had to sell. So if you wanted to sell your certificate, they had to purchase it from you. That was the rule on the New York Stock Exchange. And if you wanted to buy, then they had to sell. You don't have that anymore.
No. And also what you do have now, which makes it even more difficult, is social media. There is no delay from an event to the world knowing about it. And it throws aside the accuracy because these stories come out so quickly that the emotions take over before the fact has really been evaluated.
Well, that's always been true with social media. You don't know what's true and what's not true.
Right, but people listen to it when it comes to the economy, the market, stocks. Like you said, there are people on TV that have these shows, and Kramer's one of them, and he could be the brightest guy. He was brilliant in his roles at certain places that he worked, but it's still an opinion.
It always is an opinion, and that's true of the social media. But the problem is that you now have TikTok, you now have Twitter, you have LinkedIn, you have all of the other social medias, and everybody can listen to those. They get instantaneous information, and they can make instantaneous moves. So you got to be careful what you do. So my advice to people is, again, get yourself a good advisor, stick with that advisor, and if you don't trust them, get rid of them.
I was reading where every time there's been this kind of market drop, it usually, from course of history, last 30, 40, 50 years, within 12 to 15 months, it rights itself, just through the attrition of time. Do you believe right now, we've been in this, 12, 13 months now, maybe 14 months, but I think there's other things that are going on along with it, but do you believe, let's say there are another couple of raises, which is very possible. We know there's going to be another point, whether it's 25 or 50 basis
Well,
points.
I already said I think there will
Yeah.
be 225
But do you think by
basis
the
point
end of this
increases.
year, things will start to level off? Because you said recession could come into play at some point. How does that affect? Now the economy levels off, the rates stop going up. However, by then you're already into, call it a soft landing of recession. Does that throw things back down? How does that affect what has happened, and let's call it the confidence that's back in the markets again, and back in the confidence of the economy?
Well, I think two things. And let me take them one at a time.
Yeah.
If there is a recession, it's going to take us 3 to 4 months before we get out of the recessionary period.
And I don't want to interrupt you. Explain what that would do.
Well, I mean, that would mean that the economy is shrinking as opposed to growing. So if you start seeing the economy grow at a pace of 1% or less each quarter, you're in a recession.
So the GDP would have a lot to do with
The
that.
GDP would be determinative of that
Right,
factor.
right.
And that would have an effect, obviously, on stocks and bonds and what's going to happen. I think there are a couple of things that are wild cards that we have to think about. One is what we talked about a little bit earlier, which is the debt limit. If the debt limit in some way or another is breached in some fashion and we default, meaning our government defaults on its bonds, on the debt that it owes, I think you could see a very serious contraction in the U.S. economy. Because right now, one of the things that drives the U.S. economy is that everybody buys our debt. And the moment that we default on our debt, everybody who's been buying our debt is going to probably stop buying our debt, and that's going to mean a contraction in the U.S. economy. So that could have one effect on it. I think the other thing that we have to consider is what's going to happen with this dysfunctional Congress that we got right now. If you can't, sometimes it's good when nothing can happen by the politicians, because sometimes their inaction is good for the economy. Unfortunately, I don't think this is one of those times.
That's what I said earlier. This is
I-
probably the most important time we needed a functional
I
Congress.
think we need a functional Congress and a functional administration in order to really be able to function as a country and be able to do the right things for our economy and for our people. So I think there will be more to come in that regard. We'll have to see what happens. We'll see how it grows. But yeah, I think things will improve.
Yeah, I mean, the feeling...
But I don't think the economy is going to bounce back
No.
in 4 to 5 months.
And their feeling, the general consensus from, call them these hedge fund owners, the Rockefellers of the world, whatever, the feeling they had is it's going to be into the mid to a third quarter of 24 before you see a true normalcy and back in. 23 will level off. There'll be a consumer confidence back in it. But to see where it was, to get back to where it was, we're still a long ways away.
Well, I would question whether or not 24 is going to be the time frame, because remember, in 24 we're going to have another election coming up. We're going to, and this time a third of the Senate will be up for grabs. You'll have the entire House up for grabs, and you'll have a presidential race. And that brings a lot of uncertainty to the economy when you don't have solid leadership at a time when the politicians are distracted because they're running on, their various extremism programs that they have. So I actually think that it may be not until 2025 before you really see a move back to normalcy.
Good. Or early 24, hopefully, but but I think I agree.
Yeah, early 2025.
Okay. So obviously I could go on and on and on with you, and unfortunately I don't want to take up more of your time, but if you had a crystal ball with all of your knowledge of your economy and such, and by the way, not to minimize that you don't, I've watched some of your videos and such where you've been around the world lecturing and being interviewed. So you are a little bit of a knowledgeable guy in the economy of the world.
Well, I was lucky.
I think you're being modest because I've heard you.
Well, I've been very lucky in that I did a lot of traveling for my former company, the Depository Trust and Clearing Corporation. We had to talk in front of a lot of regulators. That was my job. Was to meet those regulators in Japan, in Australia, in Europe, and explain to them what we could do to be helpful to them and what we couldn't do. But also to be as helpful as possible for the U.S. government, because even though we were not a governmental entity, what happens in the U.S. government obviously has effect on the economy. What happens in the economy has an effect on our business. And even though I'm now retired from that business, as a retiree, I always remind people the health of the company that you retired from is always important, because they're paying your retirement income. So you want to make certain that they do well. But
I
thanks
can't.
for having me, Bob.
Oh my God, it's been our pleasure, and I hope to have you back. And we won't wait till 25 to see what happens.
Okay.
We're gonna take you for the word, and you're gonna tell us that you feel by the end of this year we're gonna be in better shape.
I never said that. In fact, I said things might get worse by the end of
Okay.
this year, but I'll be happy to come back later this year and see
Okay.
which prediction came true. Yours about it getting better, or mine that it's going to get worse?
I'm not. I'd rather I win in this case, but again, time will tell.
Thank you.
I think you can understand now why I asked Larry to be with us today, and it's an honor, it's a privilege, but he's our neighbor. That's really more impressive, that you can come up to him at the bar, we can talk, and we've chatted many times. Larry also is part of our legal committee for the island, so he has been very instrumentally involved with me in many of the issues that we've had to deal with island-wise, and you can understand now the caliber of the intellect and the experience that is part of our leadership on Williams Island. Larry, I can't thank you enough. I look forward to having you again, but I look forward to having a glass of wine with you at the bar,
Thank you.
and thank you all for listening very much.